Credit exposure is the amount that can be potentially lost if a debtor defaults on the obligation. What you need to know for the exam is two things basically. One, what does exposure consist of? Exposure is two types. You've got the current exposure, which is how much does the client owe you on the loan now, currently. And you've got the future exposure or the potential exposure. Is there a chance that the client might default in the future? This is the first question. And the second question usually comes is, how do you calculate potential exposure? Current exposure is easy because you know now, it's in the present, it's not complicated. That's the current exposure. For the potential, you are trying to predict what's going to happen in the future. So you're going to need to use some mathematical equations. And to answer this question, we use the value at risk formula, the value at risk calculation. You will study these in the next chapter. Value at risk can be used to calculate or to estimate or to predict credit risk and market risk. We'll study it in the market risk chapter in the next chapter, but it can be used for credit risk. So the two questions from this page are, what are the two types of exposures, current and potential? How do we calculate or how do we predict our potential exposures? Through the use of statistical tools like value at risk. The second way you can measure your risk is through risk premium. Risk premium tells you if there is a trust in the bank or no, if there is a trust in the company or no. So this can be actually used in combination with credit risk ratings. So if a company has a rating of AAA and it wants to borrow money, everybody will be happy to give the company money because it's highly rated. And when it borrows, it's gonna borrow cheap. That means it's gonna pay low interest. You can see that in bonds. Companies, AAA bonds have low coupon. Because in finance, the lower the risk, the lower the return. But if a company has a rating of C, which is considered junk or high yield, and it wants to borrow, it will pay high interest. That's a question in the exam. The relationship between a rating and the borrowing cost on a company. So what is the risk premium? Those of you who have done the ICWM qualification might remember this. A risk premium is anybody who has money and wants to invest that money has two choices. They either go for a risk-free investment. So if you have some money, you can do the risk-free and then you can earn probably 1% to 2%. Well, we are in March 2020 and it looks like we are facing a recession because of the coronavirus. So the risk-free rate have dropped below 1%. I think it's now sub 1%, around 0.9% or something like that. This is currently today. Now, or you can choose to look for higher returns, but you need to take risk. You need to invest in risky investments, and then these risky investments might pay you, let's say, 4.9%. So you have chosen to earn an extra 4%. Why? Because you have chosen to take risk. 4% is your risk premium, your reward for taking extra risk. That's your risk premium. The same thing can happen in credit risk premium. Credit risk premium is a bank has money from the deposits, for example, and the bank wants to use that money to generate profit. How can the bank use that money? So the bank can either use the deposits to invest in a risk-free investment, and the bank will earn a small return, or the bank might choose to take some risks. And in this case, the risk is give these money out as a loan. Give Kareem a loan and charge Kareem 4.9% on the loan. Now, the bank is making more money, but the bank is now taking risk. So credit risk premium tells you how the difference between the rates that the bank is paying and the bank is receiving because it has chosen to take risk. And we continue with the credit risk measurement. Now we're going to look at credit risk ratings. Again, those of you who have done the ICWIM are probably aware of this. Credit risk ratings are a popular question in the exam. You might get any one of these following questions. The first one is the difference between investment grade ratings and non-investment grade ratings. So investment grade, these are high quality bonds, high quality credit, and this is low quality. Although it's not written here, CISI, usually in finance and not just in CISI, we refer to them as high yield bonds. So what separates high quality, low yield? Because high quality means low risk, and low risk means low return. So what separates high quality from low quality is this line here. Anything triple B and above is high quality or investment grade. Anything double B and below is low quality or non-investment grade. That's the first question. The second question is on Moody's. If you notice that Moody's has a slightly different rating than S&P and Fitch. S&P and Fitch are the same all the way down. Except for Moody's. Moody's is a bit different. It has small letters after its ratings. So that's the second question you might expect. The third question is, CISI will say, for example, a bond's rating has changed from BAA to A. What effect does that have on, for example, the price? Well, the price is going to go up because there is a higher demand. And because the price has gone up, the yield on this bond is going to go down. Watch out for the coupon. The coupon is always fixed. Well, at least in this qualification. And of course, the opposite is true. So what if a bond's rating has dropped, or the CISI won't say went up or down. CISI will just say the rating has changed. They expect you to know whether this is an upgrade or a downgrade. So if it has changed from BA to B, that is a downgrade. So what happens? The price is going to go down because of lack of demand. And because the price went down, the yield has gone up. But again, the coupon remains fixed. So any one of these questions will come in the exam. Another question might come, and you are most likely to get that question. And the question is, what are the limitations, the disadvantages of using credit ratings in risk management? Well, credit rating agencies, S&P, Moody's, and Fitch, have been under fire recently, especially after the 2008 financial crisis, because of the way that they handled the credit ratings on the bonds that defaulted. The limitations, disadvantages of credit ratings, there's a big chance they will come in the exam. They do not capture market or liquidity risk. They are opinion only. I mean, after the 2008 financial crisis, people tried to sue Fitch, Moody's, and S&P because they were giving high ratings to junk bonds. But of course, they couldn't sue them because a rating, which is a AAA or a double B, is just an expression of opinion. These companies think that this bond is triple B, and you can't sue somebody for his opinion. So they are opinion only. Downgrades have not happened quick enough. I mean, if you remember Enron in the year 2000 or 2001, when they failed, when Enron collapsed, Enron was bankrupt, but yet they still had a high rating. I mean, when these rating agencies were asked why, the usual answer is, we want to give companies time to recover. So we don't like to change the ratings very often, and this is a disadvantage. rating agencies have been too familiar with company management, and of course this means conflict of interest. Recent errors in judgment in using structured products, and they are too reactive. Too reactive, that means they wait for something to happen before they take actions. Of course, reactive is the opposite of proactive. Proactive means you don't wait. Opposite of proactive. Proactive means you don't wait. You take action before the bad thing happens. Reactive is you take action after the bad thing happens. Let's continue. Measuring credit risk. Whenever a bank gives a loan, the bank calculates the expected losses on the loan. So what if this borrower defaults? How much do we stand to lose? That is the expected loss. Now, although it looks like a formula, mathematical formula, honestly, we have not seen, or our students have not told us that they got it in a mathematical format. So that means you will not be required to calculate. You will mostly be required to understand what is involved in the expected loss. What numbers do you use? You're expected to know what PD, EAD, and LGD mean. Basically, that's it. Very rarely would CISI give you numbers and then ask you to calculate. We are going to take a case study now, just to tell you what these numbers mean. But for the exam, just memorize probability of default, exposure at default, and loss given default. So let's do a quick example here. So a bank lends, let's say, $100,000 to Kareem. Kareem provides $70,000 in collateral. That means he mortgages his house or his car or whatever that is. And so let's start here. $100,000 in this case is the exposure at default, the EAD. If Kareem provided a $70,000 in collateral, what is the bank's actual risk? The bank's actual risk is $30,000. And we need to put this in percentage terms. So this is 30%. That's the bank's actual risk. This is called the loss given default. That means if the default happens, how much is the bank losing? The bank will lose 30%. And then looking at Kareem's profile, the probability of default, because usually the bank has segments and profiles on the clients, the probability of default on Kareem, looking at his income, his assets, probably his nationality, probability of default on Kareem is, let's say, 10%. This is called the probability of default. So you've got the three numbers now. It's exposure at default times loss given default times probability of default. The exposure of default is always a dollar amount or a pound amount. The loss given default is always a percentage, and the probability of default is always a percentage. So it's $100,000 times 30% times 10%. How much does the bank expect to lose? $100,000 times 30%, so that's $30,000 times 10%. So the bank expects to lose $3,000. This is the expected loss. In the exam, watch out for words like exposure given default. That doesn't exist. There is no such thing as exposure given default. There is exposure at default, but there is no such thing as exposure given default. Or loss at default. That doesn't exist. So loss at default doesn't exist. There is a loss given default, but there is no loss at default. And the next page is another example of what we've just explained. No need to repeat what we've just covered. but it's pretty easy.